The rescue rope snaps. A homeowner thinks the worst part is over. They survived years of payments, built equity, and waited for the mortgage renewal notice. Then the new number arrives. It is hundreds more every month. Not for a bigger home, not for a renovation, but for the exact same roof. So they reach for the obvious escape hatch. Refinance. Stretch the loan, lower the payment, buy time. Then the bank looks at the house and says no. Not because the homeowner stopped paying. Not because they disappeared. Because the home is worth less than expected. And the bank now sees the rescue plan as too risky. The payment is rising. The escape route is shrinking. And for some owners, the front door now feels like a locked cell. What if the door is already locked? For years, cheap debt made homeownership feel safer than it really was. During the pandemic, central banks slashed rates to keep economies moving. In Canada, the key policy rate fell to just 0.25%. That low rate moved through the financial system and changed what buyers believed they could afford. Commercial banks offered mortgages near 1.5%. Suddenly, a huge loan looked manageable because the monthly payment looked almost gentle. That was the illusion. Cheap money has a hidden timer. Many borrowers locked those rates for 5 years, assuming the future would be easier. But inflation stayed stubborn. Prices rose across daily life, and interest rates climbed back up. Then it snapped. A mortgage that once felt stable became a countdown. When the 5-year term ended, the old deal vanished, and the new rate looked closer to 4%. The roof did not change. The neighborhood did not change. Only the math changed, and that was enough. Here is the trap in numbers. Picture a $400,000 mortgage at 1.5%, paid over 20 years. The monthly payment is just over $1,900. That is already a serious bill, but at pandemic rates, it could feel possible. Tight maybe, risky maybe, but possible. After 5 years, the borrower has done something real. They have paid down about $90,000 of the loan. On paper, they are safer. The mortgage is smaller, the finish line is closer. Then renewal arrives. If they stay on the original plan, they now have 15 years left. But the rate is no longer 1.5%. It is about 4%. The payment jumps by more than $350 a month. That number can sound survivable until everything else is rising too. Groceries cost more. Fuel costs more. Insurance, repairs, and utilities all press against the same paycheck. The bank is not asking for a luxury upgrade. It is asking for more money to keep the same home. That is the cruel part. A borrower can control some spending. They can delay travel, cut restaurants, cancel subscriptions, and postpone repairs. But they cannot personally reset interest rates. They cannot make food cheaper. They cannot force wages to rise. So the owner searches for the lever they still control. Not the home price, not the bank rate, the length of the mortgage. This is where refinancing enters. A renewal usually means continuing with a lender at a new rate. A refinance is bigger. It can rewrite the mortgage, change terms, and sometimes extend the amortization period. If 15 years left makes the payment too high, stretching it back to 20 years can lower the monthly bill. The debt lasts longer, but the immediate pressure eases. The household gets room to breathe. The bank gets something too, because longer loans usually mean more total interest paid over time. On the surface, everyone wins, but only if the bank opens the door. Many borrowers have already used that escape route. According to the Bank of Canada's latest financial stability reporting, about 70% of people who refinanced in recent years extended their amortization. The average extension was 6 years. That tells you something important. This is not a rare financial trick. It has become a survival tool for households caught between old debt and new rates. But refinancing is not automatic. It is a new negotiation with a lender. The bank checks income, employment, debts, credit history, and the value of the property. That last part is where the floor can collapse. The home is collateral. If the borrower cannot pay, the lender may foreclose and recover money through the property. So the bank cares deeply about what the home is worth right now, not what it was worth during the boom. And home values have fallen. Across the country, average prices have dropped by around 20% in only a few years, depending on the measurement used. In some markets, sellers are discovering that avoiding a loss can feel like a victory. That changes the entire risk calculation. Suppose the borrower originally stretched hard to buy. Their mortgage was already near the edge of what the lender allowed. Maybe their loan-to-value ratio was almost 90%. That ratio compares the mortgage balance with the property's value. If the home is worth far more than the loan, the lender has a cushion. If the numbers are close, the cushion disappears. A loan-to-value ratio of 75% can already be seen as risky. Now imagine the property value falls while the mortgage balance remains large. Suddenly, the ratio can move toward 100%. The house no longer protects the deal. It threatens it. This is the mortgage prison. The borrower needs help because the payment is rising, but the falling property value makes the borrower look riskier. Because they look riskier, the bank may refuse to refinance. Because refinancing is refused, the higher payment stays. The escape hatch closes exactly when it is needed most. This is different from simply being unable to afford a home. The borrower may still have a clean payment history. They may have made every payment for years. They may have done what lenders asked, but the market moved against them. That is why the trap can feel so unfair. The owner is punished for forces they did not control. Rates rose, prices fell. The bank's model changed. The household did not need to fail for the math to become dangerous. The pressure is especially concentrated in major markets like Vancouver and Toronto. The Bank of Canada has warned that nearly 1 in 10 mortgage holders in the Toronto area could be unable to refinance or renew with a new lender in 2027 if prices stay depressed. If home values dropped another 10%, the affected share would rise to about 7% nationally and 12% in the Toronto area. That is not a fringe problem. That is a meaningful slice of borrowers trapped by arithmetic, and the next wave is already visible. The Bank of Canada estimates that about 12% of mortgages, with 5-year terms expiring in the next 12 months, are facing monthly payments at least 15% higher than before. That group is exposed because they locked in when rates were extremely low. They are now renewing into a world that costs more everywhere. Borrowers with shorter terms have often adjusted already. Variable rate borrowers have also felt higher rates sooner. Their shock may be smaller because the pain arrived earlier. But the 5-year fixed borrowers from the lowest rate era are different. They were sheltered for years, then hit at the edge of the cliff. And cliffs do not negotiate. By the second half of 2027, the gap may shrink for later renewals. Those borrowers did not necessarily start from the same ultra-low rates. The most extreme shock belongs to the final wave of pandemic-era deals. That does not mean collapse is guaranteed. Overall mortgage defaults remain fairly low and stable, according to the Bank of Canada. Most households will adjust, cut back, extend timelines, or find some way through. But averages hide disasters. For the individual borrower denied refinancing, stability in the wider system offers little comfort. Their monthly bill still rises. Their property still appraises lower. Their options still narrow. A low default rate does not unlock a trapped household. The lesson is brutal but simple. A mortgage payment is not just the price of a house. It is the price of interest rates, home values, lender rules, and timing. Cheap debt can make a large loan look safe. Rising rates reveal whether it truly was. Falling property values can remove the backup plan just when the payment shock arrives. That is the hidden risk many buyers never see. Equity is not only wealth, it is negotiating power. When equity shrinks, choices shrink with it. For homeowners, the danger is not always missing a payment today. Sometimes the real danger is losing the ability to change the deal tomorrow. Because the most frightening trap is not a foreclosure notice. It is the moment you realize you are still paying, still trying, still current, and still stuck. The trap begins quietly: a low rate, a stretched budget, and a belief that refinancing will always be there. Then prices fall, rates rise, and the rescue rope turns into another knot. A house is not a safe place if the loan can lock you inside.